Brad Williams, Frugal Finance. I went through rather quickly in terms of that second situation where if there was an early repayment. Let's go over this again. Early mortgage repayment, as noted over here, this is the example I'm talking about, where if there was an early repayment, the rate would be 20.57. Is that accurate? No. This is just the first example. The cost from 80 to 90% was 20.57, but what if there's an early repayment? The question that we're posing here. I went through rather fast and I didn't really explain it. We went from 12 to 13%, 90,000 loan, 80. We have this 842 is the monthly payment for the 80%. The 90%, we have 1,015. What happens after the 5th year? How much of the loan is still outstanding? 76,000 on the 80, 86,000 on the 90. The difference, 10,117. We got to do some discounting. We got to figure out the present value. And what we're doing here is we're looking at 60 months, we're looking at 5 years. C21, 172.47. Again, we've been working with that number forever. C24 is this difference, 10,117. So we're trying to find this present value deal based on the 172.47 difference between the 80 and the 90. The original was 10 grand and we're multiplied times 12. Why? Well, because we're looking, this rate only computes this on the monthly factor. In the end, 20.83% if we prepay this early. Again, you're shaking this off going, so what? Well, what if this is a $400 million loan? You can use this in a commercial setting. It doesn't matter. Anytime you're looking at fixed instruments, you can play this present value game. So just keep in mind the strategies. If you're a strategist for a large bank, you can implement these hypotheticals. Well, what if we increase this by 0.25%, 12.25%? And we know statistically the average borrower refinances or sells within 5 years. If you're working on a bonus related practice, you're going to work these numbers backwards and forwards to see what's advantageous. And then if you're borrowing, you're going to go, no. You're going to shake your finger going, I'm going to find an alternative. You guys are just getting a little greedy at this 20.83% in a 12% market. So again, Frugal Finance, what this is all about, trying to turn over some rocks to see who's making the money and how you can save. In this case, we cannot simply solve for an interest factor and use the tables to find interest rate. This is because there are two present value factors in the above equation. To find the answer, we must find the interest rate that makes the present value of the monthly annuity and lump sum equal to 10 grand. The method for doing this has been discussed earlier. The reader should be able to verify that the incremental borrowing cost is now 20.83%, as noted above here. Thus, early repayment has increased the incremental cost of borrowing from 20.57% to 20.83%. As we will see next, the impact of early repayment may be greater when there are also points involved on one or both of the loans. Brad Williams, Frugal Finance. Thanks for watching.